Okay, good evening, everyone. I'm so glad to see that there's so many people who are here on time. There's a whole bunch of you guys here already, so let's just start it on time. Today we'll be talking about something that's at least I think really interesting and really key to investing, right? That means having the right mindset, right? And of course, everyone wants to make money, everyone wants to grow their wealth, but without the right habits and the right mindset, it'll be very difficult for you in the long term because you're bound to make mistakes, primarily because its mistakes are driven by emotion, and it's part and parcel of life. It's part and parcel of investing. But if we don't address it, you'll make these mistakes continuously, and obviously you don't want that. But we'll discover today some of the common psychological traps that you can fall into, some of the behavioral biases that people are prone to, especially when investing. Because after all, as we'll discover, we're only human. So welcome to tonight's webinar, and also for everyone's information, we're also live on YouTube. And if you have any questions, please drop it in the Q&A box down below, and my teammates will get it to me or they'll answer it as well. So I hope this will be an engaging webinar and you learn a thing or two. I do have to say as well that it's quite a timely event that we're having tonight, because yesterday we had quite a rocky markets. The markets were rocky. They were down 2%. And some of the headlines that came up overnight was markets experience worst drop since August, right? When in August, in one day, the S&P fell 5%, and then yesterday it was down 2%. So, some of you might have known this, some of you might have not, but the fact remains that markets are always emotional, and if you are an investor, if you are a participant in the markets, you will also be emotional as well. Short disclaimer here. And here's the agenda for today. We'll be covering 3 areas. The first part is really about admitting that we are, as humans, emotional beings, and that when it comes to investing, 2 emotions dominate our mindset, which is fear and greed. Of course, under fear and greed, there are a variety of other emotions that are attached to that as well. But the 2 main categories are fear and greed. And as a result, we as investors, both new and experienced, fall into common psychological traps. We'll cover that in part 2. Some of these traps you may have experienced before. And just so, we take something away from this webinar, of course, without the right mindset, and you won't be in control. So in the final part, we'll be talking about overcoming your emotions and pairing this with your logical thinking as well. Because it's not about eliminating your feelings, your feelings and fears. It's mainly about coupling it with your logical thinking. Okay, so the first part, fear and greed, I think is something super common in investing, and it's something that we as humans feel on an everyday basis, but it's very, very prevalent in investing. So emotions are what makes us human. We are social creatures after all. We want to belong, and because of this, we are hardwired to have feelings and to understand each other's emotions. And emotions do, for the most part, serve us well. In the way we interact with each other, we are able to empathize. But feelings and emotions are often a liability when it comes to making rational decisions. Sometimes we are also driven by emotions and not aware of it as well. So imagine, everyday experiences, right? Going to a restaurant and ordering when you're hungry. Maybe you order a bit too much. Or maybe when you're shopping, you look at something and you're attracted to the price because you feel it's affordable only because it has an 99 cents at the back, right? Because it's not $30, it's $29.99, and all of a sudden you're like, actually, that's a pretty good price. All of these common psychological experiences are things that are commonplace. And in the finance world, it's easy to be emotional as well. Remember the last time you were flustered when you were doing your taxes, you were confused when you were buying or comparing insurance products, or maybe you got too excited when someone gave you an investing recommendation or when someone gave you a hot stock tip. We all feel it, it's normal, but the first step is to acknowledge that we are driven by emotion. And just to illustrate this point further, here is a typical kind of up and down market cycle and the feelings that are associated with this market cycle. So you start first maybe with a sense of optimism and excitement. You know, when you first invest, you feel like you are taking control and you want to grow your wealth. You maybe your friend gave you and some advice in terms of where to sign up and what to buy, and you know, let's say you take advantage of that information and you dive right in, and then turns out that timing was actually pretty good. Your investments went up, the stock maybe went up, and maybe you can relate to some of the euphoria you feel when it first goes up. You know, you start feeling like you're a really good investor, you have really good timing, and maybe you thanked your friend that told you about it, and maybe you told some other friends, hey, it's time to get in, and markets are rising, markets are going up. Maybe you even start mentally spending this money that you don't have yet. Maybe your 1,000 investment suddenly became 1,100, and suddenly you're thinking of buying things that you haven't realized yet, right? And then when the markets go south, suddenly you feel your feelings turn. You feel nervous. This is all part of, you know, fear, of course. And then maybe during a particularly bad day, when the headlines are very scary and you don't really want to reach out to anyone because you don't want to admit that you're nervous or you're worried, then you panic and maybe sell everything. Maybe you sell your entire fund, or you sell all your stocks, or you sell one particular stock that you are in. And then at the worst of times, you feel, you know, kind of defeated, and you tell yourself, okay, investing is not for me. Or maybe you might not even take accountability and you say the friend that offered you this advice was shouldn't have, or maybe you put your money with a fund manager and you said that the fund manager was mismanaged my money and they should know better. You know, this is where you can really kind of saving yourself some face, because you don't want to admit that you were wrong or that it was the wrong time to sell. And then maybe you give up, right? But and then you put your head in the sand and you don't want to think about investing again. But then some time passes, and then maybe one day someone tells you, actually, the markets are coming back, or Bitcoin is rallying, or this stock is got a second wind. And then maybe that sense of defeat kind of translates back into a little bit more optimism, a little bit of hope, and then the cycle continues again and again, right? And if you do not realize this and you do not overcome this, you're going to just go through these emotional cycles again and again. And let's also reflect on the last time you made a financial mistake. And maybe you remember, if you were driven by emotion, maybe you splurged on something you really couldn't afford. Maybe you were pressured into buying a car when your old car was doing just fine. Or maybe you bought a stock not knowing much about it, and then you panicked when it fell, or you felt really good. You felt some sort of excitement or euphoria when it was doing very well. So just spend maybe a couple of seconds thinking about the last time you made a financial mistake, right? And maybe reflect on the fact that maybe it was driven by emotion. And to make matters worse, the media is also designed to so-called engage you, or in other words, provoke a response, right? And, you know, it's really meant for you to feel something. So you probably feel fear or greed if you look at some of these scary headlines. On one hand, you might feel fear when you read a bad headline, or you might feel greed when something rallies a lot, and then you feel FOMO, right? So it's really just a variation of fear or greed. And you know what they say, right? You are what you eat. You know, so when it comes to information, it's the same thing. You are the media or the information you consume. So let's look at this headline. So the first one over here says Wall Street ends 2022 with the biggest annual drop since 2008. So what they're really doing here is quite clever, right? From a provoking point of view. So yes, 2022 was a bad year, but it was by no means driven by a financial crisis. But they are bringing up the ghost or the specter of 2008 to kind of relate your past fears to today, right? So they're really trying to compound your fear. And if you look at the second one, right, about Chinese stocks losing trillions, like your brain cannot even really understand what 1 billion is, let alone what 1 trillion is, right? Or 6 trillion in this case. So it's really about sparking intrigue so you can read this article, but if you take it out of context and process it in the wrong way, then you say, okay, I will never invest in Chinese stocks ever again, right? Or if you look at these, YouTube thumbnails, Japan just broke the US stock market because of the yen carry trade and all that. You can see that it has 1.8 million views. This was very recent, But then in the same week, the market recovers. And before yesterday's drop, we were 20 points away from all-time highs again. So these things are sensationalist. These things are meant to engage you and provoke you to make you feel something. So be careful of these traps as well. So this webinar is really here to tell you that for the most part, the right behavior trumps technical knowledge, and that you have to develop the right mindset when it comes to investing. You may not have the knowledge of a professional trader or the tools, but with simple traits, simple virtues like patience, discipline, and self-control, you can actually be a great long-term investor, okay? So now let's look at some psychological traps or behavioral biases that we as people go through. There's 4 main kinds of behavioral biases. So some of you may relate to some of them, some of you might even know some of them, but let's just go through them one by one. Okay, so self-deception, maybe, things like overconfidence comes into play. You tell yourself, yeah, I'm new to investing, but because it was my idea, I selected the stock, I'm doing it, I'm special. So it's a great idea because I came up with it, right? You kind of attach your self-worth to the decisions you make. Simplification, this is essentially, taking your past experience and simplifying or oversimplifying something to where you kind of admit to yourself that it'll be fine, even though you fully don't really understand what's going on. Maybe you were being pitched a financial product. You were presented with a lot of charts and a lot of data. And then, you go to yourself, I don't really understand fully what's going on here, but the salesman seems like a pretty nice guy. And based on my past experiences, it'll be fine. Maybe I'll just try. Right now, I'll just try with 5,000, 10,000, right? And then there's emotions, right? Try remembering the last time you were angry or you were tired and you snapped at someone. And when it's also like how you react during different points on your day, right? Before coffee and after coffee, very different, right? Sometimes you read the headlines and you're like, oh my God, the world is going to end. So a lot of these are so emotionally driven or physiologically driven. And then there's also social pressure, right? My friend bought this stock and he told me that it's a good idea. Maybe I should too, because he works in finance. So he knows what he's doing. He knows what he's talking about. Maybe I should just do the same, right? So social pressure is very real. So let's look at a couple of behavioral biases that are more kind of prone to investors who are new. Okay, so the first one here is overconfidence. Maybe some of you in the audience today are eternal optimists, right? You feel like everything will be fine. You feel a sense of confidence, which is all good because maybe your life has worked out, but sometimes you may be prone to being overconfident. So one test that you can do now to see whether you are a little bit overconfident or you are an eternal optimist is how many of you actually know the number that you need to retire? Is it 1.5 million? Is it 2 million? Is it 3.46 million, right? Do you know the number? Okay. And if you don't know the number, you need to do a bit of homework. But let's say maybe you roughly know the number. You say, okay, fine, 2 million. Then I can draw about 4,000 to 5,000 every month for 15 to 20 years. Okay, fine, you roughly know. Answer me this. Do you know if you're on track to reach that 2 million? Maybe, maybe not. Some of the people that you know the number may not know if they're on track. But you feel you'll be fine. You might feel like I'll get an increment, I'll get a bonus, I'll be rich, someone will support me. So this is really where the overconfidence come into play, right? Overconfidence is when investors overestimate their skill or knowledge, trade too frequently, incur higher costs, and ignore the relevant information and feedback. There was a study done, and they asked these fund managers, professionals, if they believe they were better than average. So of course, average means, 50% will say they are above, 50% will say they are below. But 74% of fund managers believe they were better than average, and that statistically cannot be true. And you add to that the fact that if you look at third-party data from certain indices out there, you benchmark that to the performance of these fund managers, the same fund managers who were polled, 87% of these funds don't outperform the S&P over the last 10 years. So how can 74, two-thirds, more than two-thirds actually, 75% think that they're better than normal, right? But actually close to only 10% of these funds beat the S&P, the benchmark. So that is clear overconfidence. The second thing is loss aversion. Maybe some of you who did not respond to the overconfidence part may have loss aversion. Loss aversion is when investors are so fearful of losses, they try and focus on trying to not make a loss. So making a loss hurts them more than the prospect of them making a gain. So how does this manifest in investing? Maybe they invest only in fixed returns, low returns, let's say something too conservative. I have the privilege of talking to a lot of clients, and I do meet some clients who have never invested in anything, but they say, I invest in fixed deposits. You are not investing in fixed deposits because you're just depositing. There's no risk. Investing comes with risk. Sometimes very little risk, sometimes a lot of risk. But FDs comes with virtually no risk. So how can you say you are investing? You're basically placing your funds and trying to grow your wealth very steadily, fine. But yeah, that's not really investing, right? Some people who have loss aversion, maybe they bought a stock, and then when tide changes, it goes down 5%, 10%, maybe 15%, they still don't sell. And even when the street is, the market is showing you information that the best times are over, and there are a lot of big ifs that really need to happen in order for this stock to turn around, but they're just blind to that, right? They just don't want to sell. And then, or some invest in a stock, and then if it's up just a little bit, they sell too early. They don't let their gains compound. They don't let it run. They don't pay attention to the prospects of better future earnings. They don't care about the future catalysts that may affect the market or the stock. They just go, okay, I've made 5% gain, 10%, I'm out. Or some people who don't admit that an investment is a loss until they have sold it, right? So the last one really is kind of putting your head in the sand. And experienced investors also are prone to behavioral biases. The first one here maybe is confirmation bias. Investors who pay close attention to the information that confirms their belief and ignores the information that contradicts it. So it's essentially a situation where you've already made up your mind, and then you find reasons to support the decision you've already made. And what's worse is that you may completely disregard any information that comes in against your decision you've already made. It's because it's very hard to hold two situations in your head. So when you've already made your mind, you have to be really mentally agile to say, okay, I was right yesterday, and then a week later having reviewed the latest facts, I'm wrong. Let me do something about it. That is very hard to do. Confirmation bias also comes in the fact that, just think about the news you read. You probably only read one or two papers that support your view, right? Malaysia maybe is not as in terms of the media landscape, it might not be as how you say, it might not be as extreme as maybe in the US, where you have right-wing media and left-wing media. And if you like left-leaning views, you only read certain papers, right? If you're right, probably you read a lot of Fox News or you watch a lot of Fox News, right? So you live in this echo chamber, your news feed, your IG feed or your Facebook feed also just keeps you in that echo chamber. Confirmation bias also comes when you make a decision and you don't want to deviate, even though you might be wrong. You might make some magical assumptions, just like this cartoon over here. Some guy's trying to do a math proof, and then it's very complicated, but then he makes this leap of faith and kind of magically comes to a conclusion, right? So then his professor's probably like questioning that part there. So confirmation bias is a very strong thing. I'm sure some of you, when investing, have also come across this before. Herding. You have probably heard about this, probably know about this. Herding it's very normal, it's very instinctive. It's very, we want to be part of a community. And we do it every day, right? Imagine if you wanted to eat Italian food and you say, I want to eat, if you Google Italian food in Taman Tun, right? And there's maybe two suggestions. One has 400 reviews, the other has 40. You're probably going to go with the one with 400 stars, right? I'm not saying that that's wrong necessarily, but you disregard the second one just because a lot of people have reviewed the first place. So herding is also interesting because even if we are wrong, we don't want to do it alone. So it's also something that the pros do, right? Even professional investors. I'm sure some of you remember the name FTX, the crypto exchange that was really hot. It was doing really well. A lot of institutional investors just invested in the company with minimal to no due diligence just to get a piece because you don't want to miss out. And then when it collapsed, and you look at the cap table of this crypto exchange, you have the world's who's who when it comes to investing. I'm sure some of these fund managers would also say, you know what? There's comfort in knowing that a lot of smart money was on the table, and yes, it was lost, but I am answerable. But in a way, I could not have missed out on this golden opportunity because of the red flags. And it's harder to explain sometimes why you were not in such a good opportunity versus the improbable black swan risk that it just implodes, and then having to explain. When you explain after it implodes, you can say, well, there was a lot of smart money on the table as well. And yes, I was wrong, but so was a lot of other people. So in fact, you should develop some contrarian views. When people zig, you zag. When people are too euphoric, that's when you need to be a bit fearful. So be fearful when others are greedy and be greedy when others are fearful. Let's now look at sunk cost fallacy. This is the very definition of throwing good money after bad. When something is not turning out well as you expected, and all the current data is showing that the investment is not performing well, the money that you have invested, the cost that has been sunk prior to that should not be part of the decision-making of putting the next dollar in. But it does, because that prior money that has been invested, has an emotional weight. It's very hard to walk away. So, and this is the case when suddenly, if you are an investor and things are not going well, suddenly you start hoping. You stop thinking and you start hoping. It's not like you're thinking, okay, this company has this factory, it's going to build this factory, it's going to be delivered on time, they're going to start shipping more product. Last time it was this, in the future it's going to be 2 times this. So I think that's going to happen, right? The sunk cost fallacy is when, okay, they plan the second factory, the factory burns down, they're not going to invest anymore. And then you say, but I hope that they will revisit these growth plans. I hope they will consider expansion again, right? So like when hope becomes your investment strategy, that's when good traders actually have long cut losses. But someone with this sunk cost fallacy might just double down on their commitment to justify past actions. And sometimes knowing when to fold is a very good thing. So let's talk now about the last bias, framing bias. This one's a little bit of something that's a little bit hard to detect, but you have to be aware of it because people presenting you information are trying to present it in the best light for them. You know, there is information that's been prepared by people who have the incentive to promote something. Maybe the influencer is sponsored, or maybe from the investment that you've made in this company, there is a whole investor relations team, a bunch of people who work in communications that work to put the company that you have invested in a very good light. So framing bias is when investors make a decision based on the way the information is presented versus the facts. So consider these two options. One of them is framed to sound more positive. Okay, it's a very fine balance. So I'll read them both. So the first one, it says in 2023, our revenues were 1 million compared to expectations of 1.3. Option 2 is in 2023, our revenues were 1 million compared to last year when they were 800,000. So, okay, here's where you make a guess which one has a bit of spin or a bit of framing bias at play. So if you pick number 1, that is the statement that is more factual. Because when it comes to investing, the market looks at forward expectations. So if you deliver 1 million when they expected 1.3, the stock is going to drop. But option number 2 is something that might be something that the investor relations team shows you, because they say, hey, we were better than last year, we're pretty good. But how it works on Wall Street is, how it works in investing is that your firm is valued based on future expectations. So if those expectations change, there will be a re-rating. So I went through quite a few behavioral biases. Some of it are emotion-driven, some of it are, simplification or self-deception, kind of a social bias as well. But here's the final part where we discuss how you can take control and how you can think better to acknowledge that your emotions are in the way oftentimes, and you need to think and act objectively. So I covered quite a few behavioral biases before, and let's go over some of the ways you can overcome them. I won't go through it all, but I'll go through a few. For example, if you have overconfidence, maybe sometimes it's worth chatting with a friend and then having them play devil's advocate. Stress test your assumptions. Ask yourself, okay, yes, I want to make this decision, but what could go wrong? Don't feel emotionally attacked because people say you're wrong. People are trying to stress test the opportunity in front of you. So if someone says, oh, maybe the market will fall, or maybe, this will happen, or this one, don't take it personally. Just take it with a bit of, it's an exercise in risk management, for example. Maybe you have confirmation bias, right? So don't close your eyes to data that disproves your thinking. If you, if in the course of having invested in something already, see some bad news, as difficult as it is, read the bad news. Do you believe the bad news? Is the bad news framed well? Is the bad news factual? Have the mental agility to then turn 180 degrees and go, okay, in the light of new information, I've changed my mind. It's a very hard thing to do, but it's the right thing to do, right? And it's also part of overcoming your biases. And the thing about this, these kind of like mental exercises that you do with yourself, you will form new kind of like neural pathways of new habits, that will kind of make it easier to do and make it easier to be less emotional when it comes to taking accountability for something, for example. So one of the first few steps is always about knowing yourself, right? And understanding yourself and your needs and tendencies is a very powerful thing because you know what drives you to do something. Maybe you like external affirmation. Maybe you like to prove people wrong. Maybe you are a perfectionist and you just like to do things a certain way. You know your drivers and you know why you make the decisions that you do. So how to become a better investor? You need to ask yourself, what are my goals, right? Asking yourself what your goals are, putting a price tag on those goals. For example, I want to retire with $3 million. That is a goal. And then sticking to that plan of reaching that goal is very important. A lot of people just kind of, in a very unstructured way, want to amass wealth, and that's a very normal thing to do. But if you have goals, it could really help you in a tight spot. When the markets fell yesterday or in August, you can kind of arrest yourself and go, okay, I know I'm being emotional. My retirement is not even 10 years away. It's 15, maybe even 20 years away. Why am I worried about today? Maybe it's even time to invest a little bit more. So knowing your goals can really anchor you. Knowing how much risk to take and admitting that it's sometimes okay to stay in your lane, it makes for a much more level-headed investor who will make better decisions rather than saying, okay, I want to try it. And then if you risk it, then you can't sleep at night. And then if you're off balance, then it's very likely that a slight wobble in the investment and you're going to say, you know what, it's not for me. So if you're not that stressed out about it, you can probably go, okay, I'll let it recover, or, okay, this is fine, I will continue investing in this, right? Risk is something that you should really, be fit for purpose and not something that you just follow your friends or think that you should be doing something. Oh, because I'm young, I should be taking a lot of risk. Just try and stay in your lane, and that would make you much more level-headed. What are your money habits? How did you grow up? And how was money treated in your household? Are you maybe a bit too conservative? You don't want to take too much risk because your parents were also conservative, or they considered certain things risky. That may not be the case for you. Do you like to spend too much? Do you like to kind of run up the credit card? All of these habits, especially the bad ones, you can identify them and improve them over time. And then lastly, knowledge is power, right? I don't want you to think that, okay, I attended one webinar, I attended 2, 3 webinars, I know everything there is to know. Learning, and definitely learning about investing and personal finance is something that you need to constantly update yourself. Market conditions change. Much more products are out there now than 10 years ago. So it's always about learning, right? There's some things that are evergreen, but not knowing what's out there and not upgrading yourself is you're not doing yourself a service, right? And if you don't invest and you don't learn while you're investing, you won't know what kind of investor you are. Some people, when I talk about risk, they're like, I don't really know whether I'm high risk tolerance or low. But that's probably because you haven't invested before. If you have invested before and you can take some of the swings, some of the volatility, then you're fine, right? But if you just haven't started, you just won't know. So, and with learning as well, there's something to be said about learning to be a long-term investor. You might think that investing seems really complicated because I look at these day traders or these professional, traders, and it looks like they have a lot of screens on their table, a lot of charts, a lot of tools. To be a long-term investor, you don't need technical analysis. You don't need a Bloomberg terminal. You probably need to learn something different. You probably need to learn about asset allocation. What does that mean? You probably have to learn about what ETFs to use. You probably have to learn about controlling your emotions, which is what you're doing today. So learning is super important. Okay. And here in the columns over on the right-hand side are kind of things you can do today. I call them, money hacks, but these are really like things you can do today. For example, you can automate a lot of your habits so that you don't have you're not bogged down by the administration of doing things when you get your salary, right? Just automate the right things. For example, having a standing instructions to transfer money as soon as you get your salary the next day, right? You transfer some out to another bank account, or maybe you use a money market fund like StashAway Simple. Just transfer it out so that you have a safety net, right? That you're building every month. Or maybe you use direct debit to invest and dollar cost average every month. You know what your goals are. You know how much you need to put aside. You know what expected return you're getting out of this investment because you've done your research. Just automate it. If you leave it to yourself, you're going to be like, okay, I'll do it after lunch. Then you forget. Then you're like, oh, maybe I've spent the money already. I know I'm supposed to save 5,000, but this month I can only save 1,000, right? So just automate it, because these are good habits that you need to do anyway. And once you've automated it, you're taking away the mental burden away from yourself. Then you can focus on in life and other things, right? And then when it comes to spending, for example, just delay certain purchases. If you really fall in love with something when you're scrolling on Shopee or Lazada at like 2 a.m. in the morning, really just like maybe put it on your list of favorites. But if you like it, 3 days later, 1 week later, okay, buy it. But if you look at it 3 days later, 1 week later, and you go, it's fine, maybe I'll just buy something else or not spend, then you probably saved yourself that money, right? Like I have done this before, right? Like in the moment you feel like really want it, and you look at it in the light of day, yeah, I could live without, right? And if you're a beginner, just start, right? Just start investing. The act of investing is incredibly valuable because it is a great teacher. Just start. Starting allows you to learn about products, markets, your habits, you know what suits you. It opens up a new bunch of conversation you can have with your friends. You can compare, like, what do you do with your money? How do you invest, right? Like it's something that can really be fulfilling over time. Okay, let's talk about time in the market. This is another key concept. Time in the market is better than timing the market. Time in the market is better than timing the market. Okay, a lot of people think that investing is buying a stock or maybe holding some crypto and then making it rich by a stroke of luck, maybe in a very short period of time. Okay, so I don't know how many of you know this, but like if any of you know this stock over here, I give you a lot of big kudos. Maybe you can put in the comments or the chat which stock you think it is. But you can see that, it's a stock that basically the chart shows how it has done this year. And I'm using it as an example to show that for the most part of this year, it hasn't done anything. And in a very short period of time, it's very quiet because it's in this 1 week here, suddenly it shot up. It shot up 3.5 times, right? And for some of you that maybe know, or some of you commented, this is GameStop, the very famous meme stock that was made famous during COVID when we were all, Wall Street bets and all the rest. So for the most of the year, there's not a lot of activity on the stock, but like until, in this week over here, in April, in this week, suddenly it rocketed, right? Because Warren Kitty told everyone that he's back, he's investing, he's trying to put this short squeeze on the hedge funds, and he held a live stream, and a lot of people watched, and he told people that he's getting into the stock, right? And he went up 3.5 times in a matter of days. So I want to ask you, how many people actually do you think realistically actually made this gain? How many got in at the peak, at the most, when it was the hottest thing? How many people actually got in and instead of making money, actually lost 80% of their money when it went from $50 back to from $50 back to about $20, right? Losing 80% of their money. So investing is not necessarily about short-term stock picking. It's not about finding some special hot stock opportunity that will just go up within a week. Everyone dreams of this, but unless you look at this every single day, unless you spend all your time on forums or on screens or talking to people, it's very hard to systematically or continuously find these opportunities. So that's the thing. This is not really investing. This is pure speculation, right? And I want to frame it that way because sometimes people think that investing in this way. And making, 3.5 times within a week it sounds very compelling, but like if you are faced with this opportunity, because I want to talk about this term called sizing. Sizing means deciding how much money to invest based on a opportunity that is in front of you. If you were faced with this purely speculative opportunity, how much would you actually, honestly, right, just tell yourself, how much would you put into this stock, in this opportunity realistically? Is it 1K, maybe maximum 5K? For those of you who are very rich and maybe very brave, say you put 10K, right? 10K, and in a week suddenly becomes 35K. But great, you made this windfall gain. 35K is a lot of money to most people, but realistically, it's not a lot of money in the grand scheme of things. It's not, doesn't put a dent in the 3 million that you want for retirement. It doesn't put a dent in, let's say, 500,000 that you need for your kids' education. So what I want to really have you guys focus on is the simple act of investing in an index fund. Long-term passive investing, okay? So over the last 5 years, the S&P was up 90%, okay? And instead of putting all your bets at one point in time, imagine investing every month steadily, here, in 2000 through COVID, even if you fell, you just disregarded that, continue putting in money as the stimulus package continues to work. And in 2022, just writing it down, right? Not panicking, not selling, just continue to dollar cost average, because interest rates were going really high and, all equities were hit. So kind of just investing here. And then suddenly ChatGPT, AI became a thing. And then the Magnificent Seven was slowly born over here. And then it's continued along here, right? So imagine of just steadily investing in an index. You don't need to worry about monitoring an individual stock. You don't need to assess the quality of management and their decisions. You don't need to read analyst reports. You don't need to look at expected earnings and that happen every quarter. You don't have to do these things. You don't have to worry about having bad headlines like Boeing or bad headlines like Tesla, because you're so diversified. You can invest with minimal stress. You can invest regularly without worrying about anything from day to day. You just have to check in from time to time, know what's happening with markets, and then you can go back to your day, right? And if you really look at any equity, most established equity indices, NASDAQ, S&P, MSCI, all world, just look at these broad equity indices, they go up over time. So imagine with very minimal stress, you put 1,000 every month. Remember, we talked about sizing, right? You put 1,000 every month, which is if you earn 10,000, 1,000 is definitely something you can put aside every month. If you earn 20,000 a month, maybe you can put in 1.5 or 2,000 every month. Just continuously put it in. If you put 1,000 every month, at the end of 5 years, you would have 60,000, all of which are automated, no stress. And after 5 years, you would have 85,000 from this investment, which is a 42% gain over 5 years if you simply dollar cost average. So this is a far simpler strategy than trying to be this day trader and constantly doing analysis, trying to time the market, perfection. So that leads us to the money hacks over here. You have dollar cost average, which I have been referencing. Dollar cost averaging is one of the most powerful tools you can use because it allows you to spread out your bets. It allows you to put your money away automatically in amounts that you can afford in this current time into something that you can just invest in passively. Okay. So another more advanced step is value cost averaging, which basically means in whatever you have invested in that is core of your portfolio, maybe it's an index or a diversified portfolio, whenever it goes down, you just invest more because you understand what you're investing in already. If something goes down, you see it as a sale, you can accumulate more units essentially. And if things go down, let's say because of of short-term leverage that makes the market go down quite a lot, you as a long-term investor can take advantage of that dip because you can then go in, putting extra money in on top of your dollar cost average so that you can accumulate more during bad times. And when you look at all these, the long-term trend is up, right? But if you look at these peaks and valleys, you see that the peaks always get reversed quite quickly. In the moment, it might feel very bad, and in the moment, you worry that it might be like a very downtrend or something like that. But you can see that in the long term, equities go up. So when you take advantage of these dips, they do recover eventually. So maybe you should even welcome some of these pullbacks. And it's something that you should look forward to because you buy something when it's cheaper and you can accumulate more, which is the true power of the dollar cost averaging, right? So doing something when, let's say, there's a very bad session in the markets overnight also helps you deal with it emotionally because you know about value cost averaging, you know about your long-term focus, and doing something about it. Okay, whenever the markets fall a lot, I just put an additional 1,000 in. I've done something about it. I can now move away from the anxiety that I worry about the world ending, and I can just focus on my day. I know that I've just bought the dip. I can move on. So this tactic also really helps you kind of calm your nerves. And after all, the stock market is a device for transferring money from the patient to the patient. Okay, couple more things I want to touch on. The second last thing I want to talk about is diversification. I know this is a very colorful and very busy and complicated slide, but basically diversification is the concept that no one invests to lose money. No one ever says, I want to lose money, I'm going to invest, right? Everyone wants to invest money, but most people lose money. And why is that the case? It's because it happened where they invest in this one thing, one stock, one sector, and if it went down during the wrong time when they were invested in it, then they have lost money. That's what most people do. So diversification, obviously is the concept where you spread your bets, you own everything, have a diversified portfolio of large caps, small caps, REITs, bonds, gold, different asset classes. And research has also shown that diversified portfolios beat concentrated portfolios over time. And it's simply because in tough markets, diversified portfolios fall less. And because they fall less, they can recover faster and your wealth can start accumulating again. Okay, so let's start looking at this very colorful chart over here. You will note that what this shows is the best performer of that asset class every year. So if you look at 2023, large caps were the best performer. You look at 2021, REITs were the best performer. You look at 2017, emerging markets, EM was the best performer. So there's almost every year there's a different top performer. So what you really want is a diversified portfolio. And AA, asset allocation, AA over here is a diversified portfolio that has all of this in it, almost in equal weight. And you can see actually that the gains after 10 years is really decent. It's on par with the asset classes that have performed around it, but with much less risk. And you obviously don't know what's going to happen next year. So you want to own a bit of everything. a diversified portfolio is your best bet. And you will see that regardless of whatever you invest in, small caps, large caps, emerging markets, developed markets, bonds, whatever, everything beats cash in the long term. So investing is a surefire way of beating what you have in cash. Okay, so what you want to do as well is actually not very difficult. In the money hacks over here, getting diversified is not difficult. All you need to access is ETFs. ETFs are a very simple tool because by buying one ETF, you have the exposure to the entire asset class. Buying one S&P ETF gives you 500 stocks. So buying one, say Asia equity exposure gives you over 1,000 stocks, right? All the listed companies in Asia. So it's not hard. Just build a portfolio using ETFs. And that's why StashAway uses ETFs. We build diversified portfolios. You buy one ETF per asset class and you're done. And imagine having a portfolio with 7 ETFs, which are really low cost, and you hold that for a long time and you DCA into it. It's not hard. Okay. So diversification is also another very, very important tool that you can use. Okay. So lastly, here are some actionable tips to kind of wire your brain a little bit differently. So the first one here is be objective. Be objective. Maybe you feel angry when you've lost some money, which is normal. Be objective. If you're in a bad situation, ask yourself, how did I get here? Was it emotions that driven me? If I do take a step back and take a deep breath and look at your investment, maybe you say, okay, actually, it's not so bad. I continue to invest. Before you ever invest, also, be objective, right? Compare what you have to other things in the market. If something comes with a potential return of 10%, what risk does that come with? What risk does it compare? How does it compare to other investments of the same risk? Similar products, apples to apples. Then you can compare, is this return better than what you would have in cash or what you would earn from your EPF, for example? Being objective is something that you can program yourself to be because you take away all the feelings and you just say, okay, what do I have to do here and now? Okay. What you can also do to drive at an outcome that's more desirable than just kind of like doing whatever and having a very kind of varied way of investing is to standardize your decision making. Before you invest in anything, always ask yourself the same set of questions so that the outcome of something is also consistent. Ask yourself, do I understand what I've invested in? What is my risk tolerance and am I in my lane? What are the fees? This exercise allows you to kind of uncover any behavioral bias. Are you being too hasty? Slow yourself down so you can avoid being impulsive. So the last thing here around understanding incentives is really also something I want to stress, because don't assume that someone selling you something has your best interests. They have different incentives. Unit trust agent, insurance agent, for example, are incentivized to make commission. They may have good intentions of introducing good products to you, but what is sure is that they will get a commission out of it. Unit trusts come with hefty fees, 5% upfront and then 2% management fees. That's 7%. The average return of the S&P over the last 10 years, something around 12%. Imagine 7% taken away from that just in fees. So you're left with 5%. 5% is very close to cash, 3%. Very close to EPF, 5-6%. What are you doing paying these agents so much in fees? So understand that incentives may not be aligned. They need to make a living. You know, agents, they need to make a living. You need to accumulate wealth over time. You have very different incentives. So whenever you're faced with a salesperson or an agent, the bank branch, always ask about fees. Don't make a decision on the spot. You can always come back, make a decision after you've done your research. Because if you use low-cost platforms or invest in low-cost instruments like ETFs, you get to keep this whole 7%. And this matters because when you're making your comparison, you will know, whether it's a good investment ultimately or not. Because if they show you the gross return of 10% or 15%, but after fees, it's only 3% or only 7% or 8% of the fees. It's a huge difference. So in this money hacks column over here, always compare. Be objective, always compare. Always ask the same question so you can be less impulsive and get consistent decision making, and always ask about fees. Okay? So just before we end, I really hope you guys, learn something today and you really start your investing journey well. To give you a little bit of a nudge, we have a promo code for you over here. You can keep this for another time. You don't have to use it today, but you can just take a snapshot of it now. After you've done your research on StashAway, maybe you feel like it's a good place to start investing. This promo code gives you a fee waiver on our management fees, which is already low because we also don't have a sales charge. It gives you free investing for 3 months if you invest in our general investing portfolio. If you already have StashAway, and I know a lot of you do, just in the promo side, the promo function, type in Wealth 2024, and then the next time you invest in your general investing portfolio, you will get 3 months of those fees. Just wanted to let you know that we have, in 2 weeks, another webinar called Growth Strategies for Your Financial Goals, where we'll go deeper into some investing concepts and go deeper into the general investing portfolios that StashAway offers. It will happen on the 18th of December, 2 weeks from now, 18th of December. So look out for that one as well. Okay. So take a picture of this QR code and hopefully you get a good deal out of investing with StashAway. So before we close, I just wanted to wrap things up here. Yes, as humans, we are emotional beings. Yes, we are prone to behavioral biases. We're prone to things like overconfidence, confirmation bias, loss aversion, things like that. But as soon as we acknowledge that we are human, we have these quirks, which can be neutralized if you behave in the right way. Right way being know yourself, understanding what it is you are investing for, how much risk you are comfortable taking, and the need to learn constantly about how to be a better investor over time. We also learn about spending time in the market, being patient, steadily accumulating wealth for meaningful things like your retirement, like your kids' education, which do cost a lot of money. So you need to dollar cost average. And then also, be a more objective and savvy investor. Compare your options, benchmark your choices, asking the same questions before you invest so you make consistent decisions. And also ask about fees. Ask about fees so you can avoid paying a lot in these costs simply because your incentives don't align with the agents as well. Okay, so again, I wish you all the best in your investing journey. This first webinar is one of a series of 3, so I hope you join us on the next one and the one after that. We have some questions here. Some people say thank you. Thank you very much. Let me check if there are some questions. I hope you dropped it in the chat. If you do, we'll try and answer them as much as we can. Okay. So I believe most of them are answered already. So if they if you have a question after this and you are a StashAway customer, just feel free to reach out to us. You can also find me on LinkedIn. Happy to connect. And if you have a much more personal question about your money, I would urge you to also ask me there. A few people are kind of already signing off and saying thanks. So thank you very much. I hope you have a great evening, and I hope to see you on the next webinar as well. Okay. Good night.